Hey, welcome again. Bharat from Rabbitcha Money. I have my colleagues Suraj and Balaji. By the way, last time we asked you.
Hi, Bharat.
Hello.
Yeah.
Hi, sir. Hey, Bharat.
Hello. All ready? Okay. So last time we asked you, what does Rabbitcha Money mean? And here's the answer. It means rabbit your money, which means multiply your money like rabbits multiply themselves.
Yeah.
So,
Yeah.
I mean, that does it. Okay, that doesn't mean, try to get rich overnight and take extraordinary risks. There are ways to get rich steadily, like rabbits multiply, without taking crazy risks. And which is pretty much what we do here, talking about those ideas. Okay, so let's get started. What are we talking about today, Suraj?
Okay, we're going to talk about another most important topic when it comes to investing. It is diversification.
Okay.
Yeah.
Alrighty.
Okay, let's start with basic. What does diversification mean in the context of investment? I mean, why is diversification important for any investor?
Okay. So, first of all, diversification can mean many things. It can mean multiple assets, like multiple stocks, It can mean bonds of multiple countries, multiple companies. It can mean multiple asset classes like gold, stocks, real estate, crypto, bonds, and maybe whatever else. Startups, right? Hedge funds. So,
Yep.
So diversification can mean many things, and diversification across assets, across asset classes, and basically, it means spreading your investment across multiple things, so that the failure in one thing does not impact your net worth significantly. I mean, that's the simple English of it.
Balaji, do you want to add anything?
Yeah, I think it's pretty much it. Diversify, across asset classes, within an asset class also you can have diversification.
Right.
So, diversify as much as possible. Yeah. But then again, there is a trade-off on that as well. How much you want to diversify,
Right.
Yeah. So,
yeah, so talking about the trade-off, another important concept is risk-return trade-off. Bharat, can you explain our viewers what is the concept of risk-return trade-off and how diversification impacts it?
Okay, so let's put it this way, right? I mean, the popular perception is, there ain't no free lunch, right? So what that means is, if you want returns, you're gonna take risks. Or if you want returns in excess of risk-free returns, right, you're gonna take risks. But that doesn't mean all those risks are rewarding. Like, we talked about this in the last video. Bad driving is a risk. Rash driving is it's not rewarding, right? So, there are many theories like capital asset pricing model and, farm of rents model, etc., in theoretical finance, which talk about, the risk-reward trade-offs. However, let's not go into math. Let's stick to simple English, right? Because we want most of our audience to be able to understand what we're talking about, right?
Yeah.
So, so in simple language, there is if you want extra returns vis-a-vis what risk-free instruments offer, like, let's say, US government bonds or any developed country government bonds, or the S&P 500 or any index, right? if you want risks in excess of that, if you want returns in excess of that, you gotta take extra risks. That doesn't mean you cannot diversify those risks away. You can still, you can actually nullify the trade-off in some sense, right? You can get returns, but you can diversify all risks that are diversifiable. So to that extent, trade-off is not the only way to look at it.
Okay.
Right. See, I think there is another downside to it is over diversification as well.
Sure.
Yeah, I mean, if you have diversified to a large extent, I mean, you would have a kind of you might lead to diminishing returns as well, and you might end up increasing your transaction costs across multiple instruments, and then so there is a downside. I mean,
investors don't transact very frequently.
Exactly. So yeah, that's the downside. But of course, there is always there's a trade-off between over diversification and no diversification. It's somewhere in between. You need to diversify, but do it in a way that you don't have the entire market spread within your portfolio. So that
No, you can do that also. I mean, there is efficient market hypothesis, right? I mean, so if you look at US or any developed market, very few active money managers manage to beat the index. So,
right.
I mean, if you own the index, which is a lot of companies, which is a lot of diversification, which is still okay.
Right.
So let's understand two things, by the way. So, okay, what do we mean by over diversification? Right? It's basically diversification for the sake of diversification, where you're adding assets,
right,
with poor quality returns, or poor returns to begin with, not quality. Right? I mean, they may be giving you below risk-free rate. They may be giving you negative returns. They may be giving you below market returns. I mean, it's okay to add a few of these instruments, a few of these assets in your portfolio.
Right.
But if you go on adding those, where are you gonna make your returns from? Right?
Correct.
So that is over diversification in my mind. It's about adding poor returns for the sake of diversification. But if you don't have poor returns, if you add meaningful returns, if you add companies with a meaningful sharp on their own, right, or other assets, I mean, be it bonds, be it any asset, then it's not over diversification, no matter how many assets that is. I mean, I think, let's put it another way, right? So if you own the S&P 500, which is 500 companies, in my mind, that's not over diversification. Because S&P 500 is still a viable, positive, sharp investment.
Right.
So you mean to say, if you are investing on an index fund, whether it is S&P 500, Nifty, or whatever it is, we have already diversified our investment. That's what you meant to say?
Correct, and that's not over diversification.
Yeah.
Okay, but let's also understand this. There are two kinds of risks. There is something called systematic risk. There is something called unsystematic risk. Unsystematic risks are asset-specific risks. They are specific to companies or the assets that you're investing in. Systematic risks are economy-wide risks, asset class-wide risks, or risks that are spread across asset classes globally.
Correct.
Right? A long-only investor, a buy-and-hold investor, cannot get rid of those.
Correct.
Systematic risk. Only unsystematic risks can be diversified away.
Okay.
That's correct.
So, but is there a way to diversify systematic risks? Yes. You gotta trade, you gotta be long short, you gotta be market neutral, you can be beta neutral, all of that. However, none of that makes sense if you do not have a reliable source of alpha.
Correct.
I mean, you can diversify very well in a long short or market neutral way, but if you do not have a source of alpha, you're pretty much going to make nothing in the long term.
Right.
Sorry.
That's true.
Can
All
you
right,
talk more about systematic and unsystematic diversification, or should we dedicate another video for that?
Let's put it this way: systematic is basically economy-wide macro risks.
The macros. Yeah.
Unsystematic is asset-specific, company-specific, or
Correct.
if you're talking about government bonds, country-specific
Right.
things.
Yeah.
I mean, that's. I mean, I don't think it needs another video unless we go into the math of it.
Right.
Okay.
Right.
Yeah, as they say,
Right.
too much of anything is bad. We just talked about over diversification. Balaji, do you have any personal experience or examples where diversification significantly impacted investment outcomes?
Yes. See, basically in your portfolio, you need to have a different asset classes. Okay. You have mutual funds, and within that, it's not that you have a diversified mutual fund portfolio. You need to also periodically change that. Okay. So the diversification is not that you diversify and then leave it. You constantly churn. Yes, it's a time-based diversification. That's one part within the asset class. For example, the mutual funds, as I said. And the second part is you also diversify across metals like gold and stuff. You invest in that, and crypto, real estate. It's like across. You need to have that kind of a diversification. Okay, so it did really help me, especially the mutual fund. A lot of people do say that it doesn't give me good returns and all that, but if you carefully churn your funds, you could make a decent returns in that.
Yeah, you could make more than what the index of the market gives you.
So the key is the time diversification, right? So you need to churn your change your portfolio time and again. You need to kind of look at it and then exit some of your positions in the mutual funds as well, and enter into new. It could be some sectors doing very well, some sectors not doing good. That's important.
Sectors do have long bull runs and long bear runs. So,
yes, absolutely. Absolutely.
So you'll have enough time to actually do that.
Correct.
If you study the macro.
Correct. These are like systematic. Okay. Systematic diversification and also time, right? So like sometimes, based on the government, you could invest in the infra mutual fund. Okay.
Right.
And that, that it's not doing, or sometimes it's not like you can invest and then just keep it. So you need to churn that over a period of time, book your profits, the same way that you do in your stocks. You also need to do it in mutual funds, but not so frequently like you do it in
not
the equity markets.
So only those who understand macros, understand the play of sectors can do this.
That's true. That's true.
I mean, I think it would be too simplistic to read the headlines on the newspaper and try to do this.
Yes. Yeah.
So diversification
because again, headlines is English, not
level
math.
of intelligence, correct?
Right. That's true.
Yep.
That's true.
Yeah.
Yeah, you can also diversify across markets as well. That's another thing. So you could invest in Indian Sensex, and as well as you can also invest in US market. But then again, having said that, stock markets are correlated anyway. So, you know, so it will help to some extent in terms of if you create your own basket, right? Like,
It will help you against, currency fluctuations, when you invest
right.
globally.
That's true. Yeah.
Yeah. Okay, let's deviate a bit from traditional markets. Okay,
Sure.
let's focus on cryptocurrency now. How does diversification apply specifically to the cryptocurrency market? Bharat, do you want to
Hardly,
add anything?
hardly.
Okay.
I mean, let's put it this way, right?
Mm-hmm.
So, I mean, let's face some reality. 90% plus of listed currencies are junk. I mean, junk in terms of market performance. I'm not undermining the quality of projects or, I'm sure there are a lot of
Right.
beautiful projects, right?
Right.
But in terms of
Right.
market performance, 90% plus of listed tokens are junk, right? And I mean,
Yes.
you can do a sharp analysis over 4 or 5 years and you will know, right?
True.
Correct.
Yeah.
So there is very little you can diversify, and anyway they're all correlated, right? So the systematic risk is very high, and it's also correlated with. I mean, the risks are also correlated with money supply, with interest rate environment, with inflation expectation, and so on.
Mm-hmm.
Right?
That's true.
So there is very little you can do. So the only thing you can do is, own high quality tokens. Again,
Right.
I prefer to, I don't like to own things which are listed for less than 4 to 5 years because that hasn't seen enough of the market. I mean, there might be other experts who can, pick these things early. I'm not one.
Okay.
Right.
Correct.
So I'm not saying don't do it. I don't prefer to do it. Right.
Right.
So do a sharp analysis. Pick things with a positive sharp, not necessarily high sharp. Right.
Mm-hmm.
Yeah.
And do a limited diversification, whatever is possible. But use that. I mean, if you have a trading edge, which is actually easy in this asset class, because it's a bloody inefficient market. Right.
Right.
And it's got a lot of fat tails. I mean, we'll talk about the statistical part of it later.
Right.
So there are a lot of inefficiencies in the market. There's reflexivity, there is feedback loops, there is,
Right.
correlation, the support of the mining costs, all of that. Right.
Right.
So it's actually not difficult to get an edge in this market. So get an edge or, collaborate with somebody who has an edge and deploy your assets to generate, trading income. I mean, you can also do staking. You can also generate staking income, yield farming income and all that. And please do that.
Right. Right.
I mean, those will help you tide over the bear markets to some extent.
Mm-hmm.
Correct. Correct.
I think we should
See, I
make
think
it another
if
video for,
no, if you also look at it, I just wanted to add a point. See, if you want to just correlate the traditional investment types with crypto, right? So like Bharat said that, 90% of the tokens are junk. So within the 10% that you have, you can still have a mix, like, okay, some kind of a correlation, like, large cap correlated to Bitcoin and Ethereum kind of a thing. And, and there are some, it's kind of, exactly. So you could still have a diversification within that 10% of tokens that you have. So,
so you can have a little bit of very limited diversification that's still correlated, right?
Yes, that's still correlated. And since the market is inefficient, there is a huge potential to get, high returns as well if you, play it well.
I mean, if you're a trader, inefficient markets help traders.
Right.
I mean,
absolutely. That's what I said.
They help invest asset pickers also, stock pickers or token pickers. However, I mean, the statistics is loaded against you because there's only 10% of good tokens to pick from. So,
Correct.
however, there's a good scope for bottom fishing because it's an inefficient market, right? So, I mean, people say timing the market is impossible, but, you can get timing pretty right in this asset class.
Correct.
It's not fully right.
Right.
Yeah, and you can also diversify against specific failures in specific tokens.
Correct.
Yeah.
That's still a valid use case.
Right.
But understand this, all assets are also correlated, just like all stock markets in the world, right?
True.
And
Yeah.
people think US treasuries are a safe haven. It did not turn out to be that way when, the Fed started raising interest rates and, the interest rate expectation went up. This was the
Correct.
worst affected asset class.
It's true. Yeah.
I mean, it crashed more than NASDAQ.
Correct.
And only slightly less than Bitcoin. So,
Absolutely. Yeah.
Yeah.
So, I mean, don't think that, asset classes are a universe on their own. They're not.
Correct.
Right. No, of course,
Right.
everything is correlated because end of the day, the money, the dollar that you put in will get translated to different asset classes as well. So the macros to some extent define a lot of things.
Right.
Yeah, and then there is some element of small opportunity here and there. You can use this correlations, cross correlations, kind of opportunities to hedge your
Yeah, but again, if you have to hedge, you gotta be, you gotta be going into not so well known asset classes, or you gotta go into a long short mode where you're long something, short
Yeah.
something else.
Yeah.
However, right? This old formula of, some percentage in equity, some in debt, some in gold, will carry you through the life. I'm not so terribly sure.
Right.
I mean, it can, but like I said, debt and the safest form of debt, US treasuries, was the worst affected when interest rates went up,
Correct.
True.
right? But I think, if you hold it to maturity, it's still a decent bet. But
Right.
you gotta have the strong hand to do that. I mean, you can only do that if you don't need immediate cash.
True.
Exactly.
So yeah, all these concepts are good if with the cash that you don't need. So
Right.
Yeah.
yeah.
Investing in crypto assets, it always comes with its own risk, a unique set of risks. Okay.
Sure.
So, what are the unique challenges and opportunities when it comes to diversifying the crypto portfolio?
Okay, diversify or otherwise, right? So there is an exchange risk element,
Exactly. Yes.
right?
Right.
And if you're if a custodian is involved in whatever capacity, a custodial risk is also involved,
Correct.
right?
Correct.
So it makes sense to diversify these things as well,
Correct.
Yeah.
Yeah.
right? If you can.
Yeah.
I
Some
mean,
of the uncontrollables.
It comes with a little bit of headache, You've got to maintain multiple wallets, multiple credentials, and
Correct.
all of that. And not lose them, not let them be hacked, at least not be careless enough to let them be hacked,
Yeah.
and so on. So it comes with a little bit of overhead effort. But it makes sense to do those kinds of diversification also.
Right.
How can
Yeah.
investors?
I mean,
Yeah, go ahead, Balaji. Go ahead.
yeah. And just another one is like we keep saying that in the crypto, very important is the uncontrollable risk is the regulatory uncertainty. It's this kind of
Correct.
which is which we can't control. But yeah, that's
But I
something
think
which
I
we'll
think
have to live with.
part of the opportunity is that because if it did not have that risk, right, it would be another traditional investment. So
Yeah, and the
Yeah,
regulations
true.
keep
so
changing.
I think this is a risk that you're being paid to take.
No, that absolutely. The problem is it's not the regulatory changes uh,
Yeah.
that's the problem. It's the uncertainty. You know, when,
No, so
what,
you're
and
being paid to take
to
that
what extent.
uncertainty.
Yeah. So that's the thing. So that is something which you cannot plan for, and it's like it's not a systematic uh, risk. It's kind of it's hard to
I mean, it's
fathom in this
definitely not
world, and it's kind of
unsystematic.
right.
It may be partly systematic, partly
Yeah. No,
uncontrollable,
it's very
whatever.
very region specific. It's not like a you know
Right.
global thing. Yeah. So therefore, uh, yeah,
But
it's kind.
understand that the uncertainty has an upside to it as well and a downside to it.
Yes,
So,
absolutely. I'm not debate. I
so
mean, I'm not questioning that part of it, but that's kind of hard to control. I mean, hard to plan for anyway.
that's true. But again, like I said, there's an upside risk and a downside risk.
Yeah.
So it's not a very. I mean, it's not like crash diving.
True. Yeah.
That's what I'm
Yeah.
saying.
Yes.
Right. Right.
Balaji, how can investors diversify their holding within the crypto market?
We answered
Um,
this. I think
I think,
we
yeah,
Oh,
uh,
we went
yeah,
through this. I mean, you can do very little, but you should do whatever little possible, and
exactly.
and generate
So,
more out of those. I
right,
mean, because bear
yeah,
markets and deep bear markets is a reality of this asset class.
okay. No
correct.
worries. I'll read this. Okay. One last question. What role do stable coins play in a diversified crypto portfolio?
Okay. See, stable coins like USDT, right, which kind of follows the USD. Uh,
Right.
it plays a very important role in it's a low volatility asset basically, which means
Yeah.
a safe
Almost.
haven during the periods of high market volatility, right? So therefore it can be used for liquidity and trading purposes. Okay, you don't have to move out of the crypto environment,
You can
to
park your money.
trade, switch between your assets. It's easier to switch between your crypto assets
Hmm.
using your stable coin without moving out of the crypto environment.
Yeah,
So
and you
I
can
mean,
park it temporarily.
exactly. Yeah, you
Okay.
can park it temporarily because it's a safe thing, and yeah, also
I
it's
mean,
accepted.
let's say you don't have an edge or you don't have a meaningful style or algorithm or technique to go short, right? So
Correct.
when you sense a bear market coming based on whatever, and you don't have the courage or the skill to go short, you can just stay in stable coins and temporarily.
Yeah, stable
and
coins are
and
more
and
like,
and, and, and get yield farming returns too, or that.
yeah, in short, stable coins are more like, simulation of traditional world inside the crypto world. Correct?
It's like cash. I mean, it's the cash equivalent of the traditional market.
Correct. Okay, I think with that question, we're done with our with this video. I think we can stop here.
Alrighty. Any other
Do you wanna add
comments?
anything? You guys wanna add anything? Any comments?
I think
Well,
I'm done. I think it's fine. You're all right.
Okay.
the path of the righteous man is beset on all sides by the inequities of the selfish and the tyranny of bad quality assets. And blessed is he who, in the name of charity and goodwill, shepherds the asset through the valley of bear markets. And he is truly the keeper of his brothers and the finder of lost money. And I will not
All right,
stop
Dave.
anybody. So,
Right.
True.
Okay, guys. So let's catch up in our next video.
Okay.
Bye-bye
all
for now.
right. Bye-bye.
See ya, guys.
Yep. See you.
Thanks for watching. Subscribe, comment, share,
Yep.
like. Just like if you will.
Yeah, we're
Something's
still
better
getting a
now.
hang of YouTube. I think we need to by heart this one.
Yep.
Like, share, and subscribe.
Well, so let's save us from the tyranny of the Silicon Valley. Let's put it that way.
All right.
Okay. Adios.
Yeah.